Hello again and welcome back. How do we account for any costs incurred to repair or improve buildings or plant or equipment during its life? How should we account for that? Generally accepted accounting principles, these are the rules established by the FASB. These rules of accounting require any costs incurred in the normal recurring repairs and maintenance of property, plant or equipment, is to be expensed in the period incurred. So maybe there are some maintenance costs, but what I'm saying here is that any cost incurred to maintain property or buildings or equipment are going to be reflected as an expense in the period incurred. In other words, we're not going to capitalize it. We're not going to reflect these normal recurring repairs and maintenance costs as part of the cost of the asset. It's an expense in the period that we incur it. For example, if we're going to do a tune-up and an oil change on our truck during the first year of its operation, and it costs us $250, we're going to credit cash for $250. But the question is, do we capitalize that expenditure of $250 or do we expense it? If the cost represents normal recurring repair or maintenance, and what I mean is costs incurred to simply operate it as we originally intended to operate it over its original 6-year estimated useful life, in that case, we're just going to expense it and debit repair and maintenance expense. In addition to this rule relative to recurring repair maintenance costs, generally accepted accounting principle rules require that any costs incurred in improving property, plant, or equipment is to be capitalized as an increase in the original cost of that asset. What do we mean when we say improvements to plant or equipment? Improvements are costs that significantly increase the original productivity of an asset or extend the useful life beyond what was originally estimated. In other words, we're going to do something to this truck that really, that either makes it faster or larger or more productive for us. I mean, if I spend $5,000 turbocharging the engine so that it'll operate more efficiently and faster, that would be an improvement rather than normal recurring maintenance. We're actually improving its productivity, and so we would capitalize it. In many cases, we may make some major overhauls that actually extend the useful life above and beyond 6 years. Again, any improvement in efficiency or productivity or an extension of the useful life as a result of the cost beyond its normal expected useful life should be capitalized. That's the rule. Now let's look at the example here. Let's assume for our truck that in the year 20X7, this is 3 years after we originally purchased the truck, the engine blows up, gives out, and we're forced to replace it, and we replace it and do a complete overhaul of the engine. It costs $7,000 to do it. But as a result of this overhaul, we increase the estimated useful life an additional 4 years beyond the original 6 that we'd expected. Now, we didn't want to do this, and it's unfortunate and stuff, but by making this $7,000 expenditure to completely replace the existing, engine and do a complete overhaul, we really have expanded the life of this truck beyond what we had originally anticipated. If that's the case, then this is an improvement. We would credit cash and capitalize the expenditure by debiting the truck. What is the total capitalized cost of this truck at this point in time is now, well, it was $65,000. Now it'll be $72,000 of capitalized cost. And in addition, it has an additional useful life beyond the original 6 years by 4. So it's got 10 years of useful life. We're in the 3rd year, so we've got 7 more years of useful life. We've got $72,000 of new capitalized cost. And if it's been 3 years, we've got $30,000 of accumulated depreciation to date. What we'd need to do from now on is make new calculations of depreciation given the new useful life and its book value, new book value at this point in time, given the increased capitalized cost less accumulated depreciation. Now, we're not going to do that here, but that is how we would handle an improvement and making adjustments given that improvement in terms of its useful life in the future. And we're simply going to modify our future calculations of depreciation to accommodate for it. Now, let's complete the life cycle of a long-term asset by discussing the last issue in accounting for these kinds of assets, the recording of the sale or disposal of the asset. Now, upon the sale or disposal of an asset, we're going to need to take the book value of the asset out of the books. Because, we're either selling that asset and don't own it anymore, or we're disposing of it and throwing it away. And so upon the disposal or sale of an asset, we're going to remove the book value off of our books. If we sell the asset and receive some compensation or consideration, some price, the difference between the sales price and the book value of the asset will generate for us either a gain or a loss on the sale of that asset. And so let's kind of examine how this will really work by continuing our example of this truck of ours. Let's assume the truck that in this example was purchased not on April the 1st, but going back to our very original example of January 1st purchase, and that the capitalized cost at the date of purchase was, again, that $65,000, $60,000 of its purchase price plus $5,000 of other costs incurred in getting it ready for its original intended use. Let's also assume that we've been depreciating that asset on a straight line basis since inception. And let's also assume that we have made no improvements. That overhaul of the engine, we'll assume that didn't take place or hasn't taken place yet, but now we're going to actually enter into a transaction to sell or dispose of this truck before we had originally intended, given a 6-year original estimated useful life. We'll assume that the truck is going to be sold or disposed of on January the 1st in the year X6. So this is 2 years following its original purchase. And then we're going to prepare, or I'd like to prepare, some journal entries to record the transaction to sell or dispose of this asset under 3 different scenarios. Again, the sale's taking place on January 1st in the year X6, so it's 2 years from the date of sale. And in the first assumption or scenario, let's go ahead and assume that we sell this truck now for $47,000 of cash. Well, how are we going to account for this? Certainly, we're going to have a debit to cash for $47,000. But what are the other entries that need to be made when we actually sell this truck? As I mentioned, we are carrying on our books relative to this truck an account referred to as truck, the asset, at its original capitalized cost of $65,000. And that is the balance of the truck account, even as we stand here selling this truck on this particular day on January 1st, X6. In addition, we have an associated Contra-Asset, accumulated depreciation, which after 2 years has a running cumulative balance of depreciation of $20,000, $10,000 under a straight line method in each of the first 2 years. If we're selling this truck, we don't want this truck reflected in our records any longer. We need to get it out of our books or off of our books. If we have a debit balance in the truck account, which represents its original capitalized cost, then we need to credit truck as we sell it for the $65,000 to get that original cost out of the books. So we will credit truck for $65,000. But since we're selling this truck and getting the original capitalized cost off the books, we also need to get any accumulated depreciation specifically associated with this truck also out of our books. If we've been keeping track of that and we have now a credit balance in the Contra-Asset account, accumulated depreciation, to remove that from our books because we no longer own this truck anymore. We're going to get rid of the asset and therefore the contra-asset. We need to debit accumulated depreciation as we sell the truck. So far I'll have a debit to cash for $47,000, a debit to accumulated depreciation to get that off of our books for $20,000, a credit to truck to get the original capitalized cost out of the books, a credit for $65,000. And if I compare my total debits with my total credits, I recognize that I have an imbalance of $2,000 credit entry. What does that $2,000 actually represent? Well, that represents a gain on the sale of the truck. You see, another way to calculate the gain, besides just kind of preparing this journal entry and kind of saying, well, what's the difference between the debits and the credits, and that represents my gain in this particular case. Another alternative calculation is to say, well, the gain is equal to the sales price, which is the amount of cash we received. We sold it for cash of $47,000, or $47,000 sales price minus the book value of the asset. This is the value that we're carrying on our books. Original cost of $65,000 less accumulated depreciation of $20,000. The book value at the moment that we sell this truck is $45,000. The difference between what we sold it for and the resulting inflow of assets in the form of cash of $47,000, as opposed to the assets that are being given up. The book value of the assets, the asset being carried in our books right now has a value of $45,000 net of depreciation. We're giving up that asset. We're receiving an asset, cash, $47,000, the sales price. We're giving up an asset, the book value of the asset being sold of $45,000. Clearly, we've improved our situation in terms of our net assets by $2,000. That represents a gain on the sale of the truck. What kind of account is this gain on sale of truck? This is a kind of revenue account. This is a kind of revenue account. Because it's revenue account, it appears on the income statement. In fact, if we were to look at a traditional multiple step formatted income statement like we did previously, gain on the sale of truck or equipment would appear under other revenues and expenses as a revenue. You see, we're generating effectively a $2,000 profit in this transaction, but we're not in the business of buying and selling trucks. That's not what we normally do. That's not our normal operations, is to buy and sell trucks and try to make a profit on them. So we will reflect the gain in what is really kind of an auxiliary or supplementary kind of a transaction, not in the normal course of business, below operating income. It's not an operating revenue and it's certainly not an expense, but it is other revenue and expense. In this case, the fact that it is a revenue means, and when we have revenue, they're increased on the left or debit side or right or credit side. What about? Revenues are increased on the right-hand side. So to credit gain on the sale of truck for $2,000 is an appropriate entry to reflect an increase or an inflow of assets as a result of some sale or something, which is revenue. This is an increase in revenue for $2,000. Now, let's change the scenario. Let's assume that instead of selling the truck for $47,000, that we were only able to sell it for $40,000. Same date, same assumptions, everything. It's 2 years after we bought it, January 1st, X6, but this time instead of selling it for $47,000, we sell it for $40,000. We will debit cash for $40,000 instead of $47,000. We must also debit accumulated depreciation. If we're selling this truck, we need to get the depreciation off of the books, this contra-asset. And we must also credit the truck for $65,000 to show the removal of the capitalized cost. We no longer own this truck. Notice, by the way, that what we're really doing here is we're removing or taking off of our books the book value of the asset. See, the book value of the asset is $45,000. It's the difference between the original capitalized cost and the accumulated depreciation. So when we credit the truck for $65,000 and debit for accumulated depreciation for $20,000 when we sell it, we're taking off a net amount, a credit of $45,000, meaning we're taking the book value off of the books. We receive $40,000. If you just look at the debits versus credits, you got 40,000 debit, 20,000 debit of accumulated depreciation versus 65,000 of credit. In order to make debits equal credits in this transaction, you have to create a debit for $5,000. What is that debit? It's a loss on the sale of the truck. The other way to calculate that loss, or effectively to verify it, is gain or loss on the sale is the amount of the sales price or consideration we received when we sold it, $40,000. Less the book value. The sales price was less than the book value, creating a loss equal to $5,000. I mean, when you think about it, we're receiving assets on our books, cash we're receiving of $40,000, but we're giving up assets that on our books have a book value of $45,000. What we have here is a net decrease in our assets of $5,000. We're going to call that a loss. Again, what kind of an account is that? Loss on the sale of truck. Well, clearly it's not a revenue, that gain on sale of truck. Loss on the sale of truck is a kind of expense. Expenses are increased on the left-hand or debit side, and so as we increase or debit $5,000, it's going to an expense loss on the sale of truck. Where would that actually appear on our income statement in a multiple step format? Under other revenues and expenses. Again, not under our operating expenses, because this is not a transaction that we typically are engaged in the normal operations of our business. Now let's go over a final scenario. Let's make the same assumptions that we've had up to this point in time, that in fact we've owned the truck now for 2 years and been depreciating on a straight line basis up to January 1st X6. But this time, instead of selling it, man, we've wiped this truck out. We've driven it hard. It clearly isn't going to have a 6-year useful life. We've worn it out right now, only 2 years after its purchase. In fact, it's so worn out we can't even drive it, to the salvage dump. What we're going to do here is we got to have to call somebody up to take it away for us and pay $500 to have them do it. How would we account for this transaction? There is no cash coming in. In fact, we have cash going out, so we're going to have to credit cash for $500 to get rid of this thing, to dispose of it. Since we're disposing of it and no longer own this truck, we must get the book value of the truck off of our books by crediting the truck for $65,000 at original capitalized cost, and its associated depreciation needs to be debited, accumulated depreciation for $20,000. If you now look simply at the debits versus the credits, $20,000 of debits, and we have $65,500 of credits. The difference is $45,500. So we're going to need to include that as a debit to make the debits equal the credits. And what is that? That's a loss not on the sale of the truck, because we're not selling the truck. That's a loss on disposing the truck. And what kind of an account is that? Well, that's an expense account. You could have calculated again this loss on the truck, in this case the disposal of the truck, by taking its sales price, which was 0, and deducting from it the $45,000 of book value. So the actual loss on disposal was $45,000, but we actually had to add to that $5,000 of cash just to get rid of it. So the ultimate total loss or cost, associated with the disposal is $45,500. But in fact, it kind of makes sense, because what we did is we paid $65,000 for this truck originally, expecting to utilize it over a 6-year period. And we started out simply allocating the amount of depreciation over that 6-year period, thinking it'd have a salvage value of $5,000 at the end of that period. But in reality, this truck only lasted 2 years with no salvage value. So effectively, what we're saying is we really probably should go back and recalculate depreciation, because we didn't show as much depreciation was probably really taking place in the years X4 and X5, because we're disposing of it now at this huge loss. So what we really have here is an understatement of depreciation in the prior years. However, as we've stated previously, we make estimates all over the place. When we make an error in estimation, as we did here in terms of its estimated useful life, we won't go back and and change the prior year financial statements will simply compensate or accommodate for that error in the current year. And so in this year, we're showing this huge loss. But effectively, that should have been depreciation in the prior years if we had properly estimated its useful life.